Volatility in semiconductor and AI stocks is spiking just as Europe faces another energy shock and central banks signal less appetite to rescue equity markets. This is vTalkInsight, Equity Pulse Daily for June 25, 2026, where we connect those cross currents to what is driving equity risk and leadership right now. Global equities are trying to find their footing after a sharp, tech-led sell-off, but volatility remains elevated rather than fading. In the U.S., index moves have been modest while the volatility gauge has climbed into the high teens, matching the sense of unease showing up across Europe and Asia. A key shift beneath the surface is in the policy backdrop. Central banks have been explicit that they are less inclined to step in aggressively if equities sell off, especially given concerns about market concentration. That matters because investors have grown used to rapid intervention whenever volatility spikes. Upcoming U.S. PCE, or personal consumption expenditures, inflation data are expected to stay elevated, with risks skewed to a higher print. That could push yields higher and pressure rich equity valuations, on top of a structural rise in Treasury term premiums linked to persistent fiscal deficits and debt levels. What makes this cycle unusual is that financial conditions in the U.S. are still described as exceptionally easy, with abundant capital available across public and private markets. Flows into U.S. high-grade credit are running at roughly 3 times last year's pace, and European corporate bond spreads remain tight, effectively pricing a soft landing. At the same time, sovereign bonds are seen as less of a safety net, and we're starting to see stress in pockets, such as Morgan Stanley's $7 billion private credit fund restricting redemptions. Growth is diverging as well, with U.S. manufacturing new orders around 57, while Germany is stuck near 0.8% GDP growth, and the UK still bears a roughly 4% Brexit drag. Taken together, the macro picture suggests a summer of range-bound indices where earnings and policy communication, rather than rescue expectations, drive equity performance. The epicenter of recent volatility is the technology complex and semiconductors in particular. The Philadelphia Semiconductor Index dropped almost 8% in a single session. Asian chipmakers like Samsung and SK Hynix saw steep declines, and Nasdaq volatility has hit a 52-week high, even though the semiconductor index is still up about 90% year-to-date. This episode looks less like a collapse in fundamentals and more like a repricing of concentration and expectations. Recent gains have been narrowly focused in technology and energy, leaving AI beneficiaries crowded, and central banks have repeatedly warned about high market concentration at the same time as they step back from explicit market support. Fundamentally, the AI cycle is still powerful. Hyperscaler capex estimates have been revised higher, with spending projected to rise from about $730 billion toward $1 trillion, and memory chip supply is expected to remain tighter in 2027 than in 2026. Equilibrium between memory demand and supply is thought to be at least 18 to 24 months away. At the same time, the AI hardware landscape is changing quickly. OpenAI and Broadcom have co-developed a custom inference chip that promises better performance per watt and per dollar, and the design went from concept to tape-out in only 9 months. TSMC is prioritizing wafer capacity for NVIDIA, AMD, and Broadcom expects custom silicon designed by model developers to become standard. These trends are driving aggressive capacity plans. SK Hynix is preparing a roughly $29 billion U.S. listing to fund major memory expansion, while Micron sits at the center of market attention ahead of earnings. Micron has already seen its stock punished despite beating expectations, as investors question stretched valuations and whether it can deliver on elevated forecasts without signaling a cyclical peak. Beyond chips, the AI value chain is widening. GE Vernova's gas turbine order book is effectively sold out until 2029 as hyperscalers secure power for data centers. Weaver Systems has raised full-year revenue and margin guidance on strong demand from OpenAI and AWS, and IBM outperformed after a partnership with OpenAI. Microsoft, by contrast, is now seen as one of the most oversold mega caps despite ongoing Azure and enterprise growth prospects, underscoring how AI leadership is fragmenting and earnings guidance is increasingly driving dispersion. Europe is dealing with a renewed energy shock just as growth remains fragile. Record-breaking heat waves in France and the UK are disrupting daily life and straining grids. Nuclear output in France is threatened by low river levels needed for cooling, and day-ahead power prices have jumped to their highest levels since the energy crisis. These stresses highlight how hard it is for Europe to decarbonize while keeping power prices competitive. Policymakers point to inadequate grid investment, fragmented banking systems that struggle to fund renewable projects at scale, and a growing dependence on imported clean technologies, particularly from China, as reasons to accelerate domestic clean industry and improve resilience. On the positive side, demand for low-carbon construction products is rising, with clients increasingly willing to pay a premium for sustainable materials. The refurbishment market is expected to grow for years because most of the buildings that will be standing in 2050 already exist today, and German residential construction is showing early signs of recovery through higher building permits. Despite these structural tailwinds, international appetite for European equities has cooled. ETF inflows that once outpaced the US have reversed since the onset of war, even as European credit spreads stay tight and fiscal policy, including infrastructure and defense spending, supports activity. Within equities, earnings momentum is increasingly decisive and investors are tilting toward less crowded, more reasonably valued areas. European pharmaceuticals, especially GLP-1 drug makers, are cited as offering better risk-reward after valuation deratings and low positioning, helped by U.S. Medicare agreeing to buy those drugs at around $50 per month. However, German plans to cut drug payments into the U.S. add policy risk for some names, while defense stocks have lost momentum as earnings upgrades stall and new supply arrives through the planned Candies IPO in Paris and Frankfurt. Recent German naval procurement decisions, which pushed TKMS up and Rheinmetall down by about 10% each, underline how sensitive that sector has become to single headlines. Across Asia, equity markets are seeing some of the most intense volatility globally, particularly in technology and chip stocks. Leveraged ETFs are amplifying swings. Domestic banks are cutting leverage to retail investors, and foreign investors have pulled significant capital from Korea and Taiwan this year, contributing to sharp moves such as a 2% drop in Taiwan's main index. Even so, Korea stands out for its resilience. The Kospi has endured 3 corrections this year without breaking its underlying uptrend, and recently outperformed regional peers with a 3.6% gain driven by optimism around a potential $50 billion Samsung buyback and SK Hynix's planned U.S. listing. That reliance on a handful of names, though, leaves the market vulnerable if sentiment turns. Energy markets add another twist. Crude flows through the Strait of Hormuz have recovered to about 68 million barrels in transit. Gulf exports have reached roughly 60% of pre-war levels, and global supply has risen by 3 million barrels per day thanks to Brazil and the U.S. Combined with a 40% drop in China's crude imports and surging electric vehicle sales, that has pushed oil prices lower into an expected $70 to $85 range, while diesel prices in the U.S. have fallen below $5 per gallon and gasoline inventories remain tight. The immediate effect is relief on transport costs and inflation, supporting cyclicals, but the longer-term question is how far structural demand destruction goes. At the individual stock level, dispersion continues to widen, especially in Europe where earnings momentum is the main short-term driver. Crowded trades are proving vulnerable as soon as upgrades fade, which helps explain why European defense stocks have come under pressure even though spending expectations remain high, and why the Candies IPO, offering up to 20% of its shares, has drawn so much attention. Transport and autos offer more examples. FedEx has delivered better than expected earnings by focusing on higher margin business and cost cutting, yet warned that rising costs and shifting trade patterns are pressuring margins and that sustained volume growth remains elusive. Volkswagen, meanwhile, has dropped to its lowest share price level since 2010, reflecting how German manufacturers are struggling with high energy costs, taxes, and Chinese competition. Avis shows how positioning interacts with fundamentals, Its shares have gained about 50% year to date. It has settled litigation with Pentwater Capital, yet roughly a third of its float remains shorted, leaving the stock exposed to sharp squeezes. On the AI side, GE Vernova's sold-out turbine backlog and Weaver Systems' upgraded guidance, alongside IBM's re-rating and Microsoft's sell-off, highlight a market that is rewarding specific cash flow visibility while penalizing crowded exposures. Pulling it together, equities are trading through a complex mix of easy U.S. liquidity, more hawkish central banks, renewed European energy stress, and extreme but still mostly earnings-driven volatility in technology and semiconductors. The structural AI and energy transition stories remain intact, yet leadership is narrowing, policy support is weaker, and crowded trades around chips, defense, and certain consumer names are facing a much tougher test. From here, the key signposts are U.S. PC inflation, Micron's earnings and guidance, European power market strains through the heat wave, upcoming bank stress test results, and signals from the NATO summit on defense and fiscal priorities. How those catalysts land will shape whether this remains a choppy, range-bound summer or turns into something more directional for global equities. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.